Welcome to Mr. Greenvestor, where we focus on building a plan you can actually trust. Today we are looking at the one retirement rule that almost every financial advisor still hands out like gospel, and I want to show you why it might be quietly setting you up to fail. If you want retirement strategies that actually hold up over the long haul, go ahead and like this video, subscribe to the channel, and share this with someone you know who is planning to retire soon. Most people spend their entire careers obsessing over hitting a magic number, whether that is $1 million or $2 million. They treat that figure like a finish line, but the reality is that the number itself was never the problem. The real challenge is what you decide to do with that money once you finally cross the threshold and stop working. The rule almost everyone follows is the 4% rule, which tells you to withdraw 4% of your portfolio each year and adjust for inflation while hoping the money lasts. This approach has been called the gold standard of retirement planning for decades, so most people accept it without ever questioning where it came from or what it was actually designed to do. Here is the tension that nobody really talks about in those fancy offices. The moment you start selling off your assets to fund your life, you are one bad market year away from permanent anxiety. Every withdrawal you make during a market loss changes the math in ways you simply cannot undo later. By the end of this video, you will have a step-by-step passive return system where your principal never gets touched. Without making this shift, you will spend your retirement checking your bank balance every morning like you are checking a sick patient's vitals. Most people follow the 4% rule without actually knowing where it came from or why it exists. Back in 1994, a financial planner named William Bengen published a study after testing different portfolios against decades of market history. He discovered that if you withdrew 4% of your balance every year and adjusted that amount for inflation, your money would survive a 30-year retirement in almost every case. That 30-year window is the entire foundation of the rule, but it is also the biggest problem for early retirees. If you decide to retire at 40, you aren't planning for a 30-year window anymore. You are likely looking at 50 or 60 years of life ahead of you, and the math Bengen used simply wasn't built to stretch that far. Using the 4% rule for a very long retirement is like following a recipe meant to feed 4 people and expecting it to feed 10. The assumptions behind the numbers eventually fall apart because they were never meant to cover that much time. The length of your retirement is a major factor, but the real danger is something called sequence of returns risk. This is the specific risk that can break your plan even if you have a large portfolio. Imagine you retire with a healthy balance and the market immediately drops 30% during your first year. Since you still need money to live, you are forced to sell your assets while they are down, which locks in those losses forever. When the market eventually recovers, your portfolio has a much smaller base to grow from because you spent the principal during the crash. The math is unforgiving because those early withdrawals are gone and can never earn interest again. If a 60-year-old hits a downturn in year 2, they might still be fine because their 30-year window is relatively short. However, if a 40-year-old hits that same downturn, 50 years of future withdrawals on a damaged portfolio can cause the entire system to collapse. Beyond the math, we have to talk about what this does to your mental health. Every time you take money out of your account, it feels like a subtraction from your safety net. You find yourself watching the numbers go down, and even when the market is doing well, you feel the weight of slowly spending the wealth you spent decades building. The anxiety doesn't go away just because your balance is high, and instead, it tends to grow over time. Many people describe this feeling as bleeding out slowly, even if the actual financial wounds are quite small. You might find yourself checking your balance every morning or running the numbers again late at night after a bad day of news. That isn't the freedom you were looking for when you started this journey, and it is really just a slower version of the same stress you tried to leave behind. The 4% rule forces you to treat your savings like a melting ice cube, where you are constantly managing the rate of the melt. What you actually want is a fountain that keeps flowing without ever getting smaller. Once you realize the 4% rule is the problem, you can start looking at what a real solution looks like. The alternative to selling off your assets is actually very straightforward. Instead of selling pieces of your portfolio to pay your bills, you build a system that generates enough income on its own. Your principal stays exactly where it is, and you live off the growth and payments it produces. Think of it like being a landlord who lives off the monthly rent without ever having to sell the actual building. There are 5 layers to this income system, and you will likely use a mix of all of them, depending on your goals. Layer 1 is dividends, which are cash payments companies send you just for owning their stock. When you look for these, the payout ratio is the most important number to check. This tells you what percentage of earnings a company is giving to shareholders, and you generally want to see that number below 60%. If a company pays out more than that, they are stretching their budget, which makes them much more likely to cut the dividend if the economy hits a rough patch. You should also look for a long history of dividend growth rather than just chasing the highest current yield. A company that has raised its payment every year for 15 years is much more reliable than a company offering a massive 8% yield that they might take away tomorrow. Layer 2 involves bonds and Treasury inflation-protected securities, also known as TIPS. You can set up a bond ladder by buying bonds that mature at different times, so that a portion of your cash becomes available every single year. TIPS are especially helpful because they adjust their value based on inflation, which ensures your purchasing power doesn't disappear over time. When you choose bonds, look at the interest coverage ratio to see how easily the issuer can pay their debts. Layer 3 consists of real estate investment trusts, or REITs. These are special companies that own property and are required by law to give 90% of their taxable income back to shareholders. This allows you to collect real estate income without the headaches of being a traditional landlord. You won't have to worry about finding tenants or fixing a broken water heater in the middle of the night, but you still get paid like a property owner. Layer 4 is a strategy called covered calls, which is a way to earn extra money from stocks you already own. You are essentially renting out your shares to another investor who wants the right to buy them at a specific price. They pay you a fee up front for this right. And if the stock price stays stable, you keep that fee and your shares. While this isn't for everyone, it can add a very consistent stream of extra cash to a portfolio you plan to hold for a long time. Layer 5 is annuities, and while they often get a bad reputation, they can serve a very specific purpose. You don't need to put your whole life savings into one, but a small amount can create a guaranteed floor for your basic expenses. Between Social Security and a small annuity, you can make sure your light bill and groceries are covered no matter what happens in the stock market. When you combine these 5 layers, you can aim for a total portfolio yield of about 4 or 5%. At that level, you are finally living off the returns rather than the base of your wealth. The fountain keeps flowing, the principal stays whole, and the stress of the melting ice cube disappears. Understanding these layers is the first step, but the real work is learning how to balance them so they stay stable through every market cycle. Building those 5 layers gets you most of the way there, but a passive portfolio without guardrails is like a well-designed house with no locks on the doors. The structure is sound until something outside tests it, and these rules are what keep your system intact when the markets eventually go sideways. Start with your cash bucket by keeping 12 to 24 months of living expenses in a high-yield savings account at all times. This money is not invested, and it is not working hard because its only job is to ensure you never have to sell assets during a downturn. When the markets drop, you pull from this bucket to cover your costs, and then you refill it once the markets recover. That buffer is what turns a scary headline into a non-event for your actual monthly income. Next, you need to set a rebalancing trigger before you actually need it. The rule is simple. If any asset class drifts more than 5% away from its target, you bring it back in line. You should do this once a year on a set date rather than responding to fear or bad news, because emotional rebalancing is just panic dressed up as a strategy. A fixed trigger removes the emotion entirely, so you can check the numbers, adjust if needed, and move on with your day. The first 5 years of retirement are the most vulnerable window you will ever face, and they deserve a specific plan. This is when sequence of returns risk hits the hardest, so you should lean more heavily on bonds and your cash bucket during this time. You are not abandoning growth forever, but you are protecting your base during the years when a badly timed market drop would do the most permanent damage. Once you are through that 5-year window and the portfolio has proven its stability, you can gradually bring your equity exposure back up to your long-term target. Dynamic spending guardrails are how you stay flexible without feeling like you are failing. Before you retire, write down a rule that says if your total portfolio value drops 10%, you will cut your discretionary spending by 10% temporarily. This does not apply to your fixed costs or your basics, but it helps you manage the flexible stuff like holidays and dining out. This is not a punishment, but rather a pre-agreed response that stops a market dip from becoming a full-blown crisis. Tax placement is the one detail most people overlook until they are already retired. High-yield assets like REITs and bonds generate ordinary income, so they belong inside tax-advantaged accounts, where that income is not taxed every single year. Growth-oriented assets work better in taxable accounts because you get to control exactly when you realize those gains. In the early years of retirement before Social Security kicks in, you can use that low-income window for Roth conversions to move money to post-tax accounts at a lower rate. For your ongoing health checks, you should track payout ratios and interest coverage ratios once a year. You are not monitoring these every time the market moves, but rather checking that the trends are stable over time, much like a yearly physical at the doctor. If a holding has a payout ratio that climbs above 75%, it is worth a closer look to see what changed. If the interest coverage drops toward 1.5, that is a yellow flag that requires your attention. The reality is that a 40-year-old and a 60-year-old will manage these controls differently. The 60-year-old needs an income floor right now, so a larger bond allocation and a confirmed annuity slice makes sense from day one. The 40-year-old needs the system to grow for decades, so more weight sits in dividend growth stocks and REITs, while they phase in bonds gradually. The structure of the system stays the same, but the proportions shift as you get older. Once the system is built and protected, there is one final shift that makes it actually work, and that is your mindset. Something that surprises most people who build a passive return portfolio is the guilt they feel when it comes time to spend the money. Even after the system is working and the income is flowing in every month, many early retirees still feel the urge to check their balance constantly. They run the numbers over and over again and wonder if they should go back to work for just one more year to be safe. The thing is, this is not a money problem because the math is already fine. This is an identity problem that stems from how you have handled money for your entire life. For decades, your financial life had one job, which was to accumulate as much as possible by saving and growing the number. Now you are being asked to flip that whole mental model overnight. But that switch does not happen automatically just because the math works. You have to give yourself explicit permission to stop saving and start living on what you have built. This is where the permission system comes in to help you bridge that gap. Take your monthly passive income from dividends and interest and treat it exactly like a salary that you earned. Give it a name if that helps you mentally, but remember that this is not your savings or your retirement balance. It is income you earned by spending years building a productive system, and spending it is the whole point of the exercise. The framing of your wealth matters more than most people realize. A landlord who collects rent every month does not feel guilty when they use that money to pay their grocery bill. They are not dipping into their savings because they built an asset that produces, and they are simply using what it produces. Your portfolio is doing the exact same thing, and the only real difference is the type of asset you own. This also explains why so many people fall into the trap of working one more year even when the numbers already work. It is rarely a pure fear of running out of money, but rather the fact that they haven't built a system that feels like a steady paycheck. Drawing down a balance feels like you are spending your life savings, but passive return feels like getting paid. One of these creates constant anxiety, while the other creates the permission you need to enjoy your time. When the system finally clicks, the anxiety starts to fade away. This does not happen because your balance got larger, but because the money is finally behaving in a predictable way. You know exactly what is coming in, and you know it doesn't require you to sell anything to survive. You stop checking the balance, like it is a vital sign, because it is no longer the thing keeping you alive. To find your own starting point, take your annual expenses and divide that number by 0.04. That gives you the portfolio size you need to generate a 4% yield to cover your costs. From there, you can reverse engineer which layers will close the gap between where you are now and where you need to be. Take one small step today to secure your future. The bottom line is that wealth isn't just about chasing a bigger number on a screen. You want a system that pays you every month without ever running dry. And that starts with a simple reality check. This week, I want you to take your total portfolio value and multiply it by 0.04. Compare that annual figure to what you actually spend each year, because that gap is your real target. Now that you know the distance, you can finally start closing it. Which layer of passive returns are you going to build first? Let me know in the comments below. If this breakdown helped you, hit like and subscribe for more weekly strategies, and share this with someone who needs a plan before they retire. I am Mr. Greenvestor, and I will see you in the next one.